Well, it's great to be here today with you all. I got the slot after lunch where everyone just had their bourbon pudding, so feel free to take a nap if you're not interested in hearing about inflation and portfolios at the moment. But I'm here today to talk a little bit about the current market environment. And as we all know, there is a lot going on in the world, both from a geopolitical standpoint and an economic standpoint. And start a little bit looking at what the implications of that might be for endowment portfolios and investing, but then also how you manage a portfolio through those potential periods of volatility in the markets that are driven by situations like these. Let's just see if this links up. All right, so our first question, we're going to start out with asking you all, are you concerned about inflation pressures and the impact on your endowment? And it's interesting to see how it evolves. I feel like you're influencing each other. But you can see the vast majority of folks are, and appropriately so. Inflation can be a difficult period from an investment standpoint. Looks like we've stabilized there. So second question, are you concerned about the impact of inflation pressures on the operating budget at your college and university or university? And very similar. What we can't ask, but it's interesting that between these two questions, pretty similar percentages. And I think that's actually appropriate. What would be interesting to know is, are the folks that are less concerned about the impact on the operating budget also less concerned about the impact on the endowment? And I will say, when we work with colleges and universities and other nonprofit clients, the impact on the operating budget is actually a big focus of ours in terms of determining how much we want to do in the portfolio. Because if your operating budget is very dependent on the endowment, and that operating budget is subject to inflationary pressures, whether it be in wages or construction costs or anything else, then you want to make sure your endowment is appreciating over the long term in line with those operating pressures. So just talking a little bit about how you build resilience in the current environment. We all know inflation has been running very high for the past year or so, initially driven by supply chain disruptions associated with COVID for the most part. The fact that a lot of manufacturing plants or service businesses were either curtailed their operations or modestly shut down for points in time and had to be ramped back up. But there are also some longer term trends that could mean inflation stays higher for longer. And versus what we've seen, not just the last several years, but really more the last 20 or 30 years. And some of those trends include things like moving from an increasingly global economy to actually diversifying supply chains and bringing them more onshore or local or to different locations. So there's not so much dependency on supply chains with parts that are being manufactured a long way away. That actually is probably a slightly inflationary trend. Similarly, transitions to the energy transition that is in place broadly globally requires a lot of investment. Whether you're a utility that's trying to move away from coal or anything else along those lines, there's a lot of capital investment that will need to take place and a lot of commodities demand that will be driven by that, on top of the fact that there hasn't been a lot of investment in commodities capacity over the last 6 or 7 years. So you're seeing an increase in demand when you don't really have the supply that you would need to support that. And then, there are some offsetting things here as well, demographics being one of them. Demographic growth is pretty slow right now, particularly across developed economies. Some economies are even shrinking in terms of their labor force. That can present some conflicting pressures, right? So declining populations aren't really good for economic growth, broadly speaking, but declining labor forces aren't really good for economic growth either, because it can create a tighter labor market. And one of the things that we'll talk about today is the tightness in the labor market. So not only are we concerned about some of the current, possibly more temporary inflation pressures that we're seeing from supply chain disruptions associated with COVID, et cetera, but we're seeing some longer term trends that might mean inflation's here to stay. And how do you solve for this? I would argue it's diversification first and foremost across your portfolios. So if you look over the last 10 years, it was very easy to be an investor in the S&P 500 and the simple bond index and hey, call it a day and take your money home. It was great. You know, you really didn't need diversification that much, but you know, markets are very cyclical and that's one decade in time. If you look over longer periods of time, diversification outperforms over any longer period that you might look at. So just a little bit about Cambridge Associates, because in case you're wondering, and I see all the footnotes here are all messed up at the bottom of the page, so I'm sorry about that. In case you're wondering who Cambridge Associates is or not familiar with us, and why I'm speaking today on this topic, we were founded in the early 1970s when actually modern portfolio theory, which looks at the impact of diversification between stocks and bonds, first was coming out of universities and PhD programs. And our founders worked with Harvard University as actually a graduate school project to implement modern portfolio theory in an endowment portfolio. That then became the status quo across some of the larger universities in the country that we worked with as our initial clients. And to this day, colleges and universities are still our largest client base as a firm. And one of the things I think we really bring to the table is a focus on a very academic approach to investing. We aren't about trying to time short-term moves in the market. Our only business is investing for our clients. We don't market product. We're not a bank. We don't take kickbacks from managers. We're very independently focused on doing the best we can, primarily for colleges and universities, but also other nonprofit institutions. And we do now have 12 offices around the world where we base our research out of globally, and over 280 investment professionals. I personally have been at the firm since 2004. And prior to that, I was a buy-side analyst picking stocks for a mutual fund company, even prior to when the internet bubble became a bubble. So I've seen multiple market cycles, and I think that's important in the current environment because folks that have been investing for only the last 10 years or so have really only seen one type of environment, and markets will change over time. One of the other challenges, though, is that the market environment that we're in today probably would be most analogous to the 1970s. And there are very few professional investors out there that were working as professional investors in the 1970s. I do happen to have some investment committee members in their very late 70s, early 80s that lived through that period. But I think it's going to be a learning process for everyone, frankly, because it's been so long since we've been through that. So let's talk a little bit about different market environments and what types of assets perform well within them. This chart, the vertical arrow looks at growth, and accelerating growth is pointing up and decelerating growth is pointing down. And then the horizontal arrow looks at inflation, and accelerating inflation is to your right and decelerating is to the left. And you can see that the environment we've been in most recently is that upper right-hand corner, where we've had up until probably at least through the end of last year, we were having accelerating economic growth and accelerating inflation. And in that environment, the assets that performed best were commodities and equities. As you all probably know from your fiscal year 21 returns, the equity markets, particularly on the private side, were tremendous in terms of performance, and a pretty poor year for bonds. We seem to be migrating this year into the lower right quadrant, where you've got still accelerating inflation based on the data that came out just last week, but starting to see some declining or decelerating growth, which is particularly poor for equities and bonds. Can be good for gold. Gold's been kind of okay this year. It's not been great, but some other real assets have done quite well, continue to do quite well in the commodity space or in the energy area. Now, one of the tricky things, of course, is one never knows when this is going to shift. Markets anticipate changes in the economy. They don't follow them. So what we're seeing in the markets today is I would say probably an anticipation of not only some ongoing inflation pressure, but possibly a recession, an economic recession as well. And markets will typically price in a recession anywhere from 6 to 18 months ahead of when the recession actually occurs. So one of the challenges with investing is it's not about understanding what is happening today. It's about understanding what is likely to happen 6 to 18 months from now versus what people's expectations are. And then the challenge then becomes, if we hit a point in time where we have inflation starts to decelerate. We thought we might actually see that with the May inflation print, but we did not. People are expecting inflation to start decelerating. If we hit that period in time, then you're going to see another shift in leadership, and you might actually see very high quality bonds like treasuries start to do better. Now that we're starting at a mid threes type yield on treasuries, that might not end up being so bad. So at the end of the day, different environments are going to help different assets perform better or worse. And this is really the fundamental reason for diversification. One might think that you could just try and time the switch from one of these to the other. But if you think about the last 2 or 3 years in particular, I think anyone that would tell you that they predicted all of the ebbs and flows that we've seen geopolitically with COVID in the economic environment, I don't think there's anyone out there that has actually done that. I remember conversations with my clients in sort of April of 2020, trying to estimate when might unemployment get back to single digits, right? And here we are with the tightest unemployment we've seen not very much later. So I think this is part of the reason diversification is key. Rather than trying to predict necessarily what's going to happen, make sure you always have a part of your portfolio that is performing well in whatever macroeconomic environment we're in. And that's particularly important for colleges and universities because you're spending every year from this portfolio, usually. There might be some exceptions in this room, but usually, which is very different than if you are saving for retirement 20 years from now. If you're saving for retirement 20 years from now, you can just put your money away. You actually really don't care about the ups and downs. It might give you heartburn, but you're investing for 20, 30 years away, and you can just let the volatility ride out. But when you're spending from the portfolio every year, you don't want to be having to sell your equities when they're down dramatically to support that spending. You want to have something in the portfolio today that might be your more inflation sensitive assets that you can sell at a pretty nice premium and use that to support your spending in a difficult macroeconomic environment like the one we have today. So a little bit more on the inflationary pressures. On the chart on the left here, I'm sure you've all seen data like this. This is just looking at US headline and core inflation. And you can see where we are on the far right-hand side. And this is as of the end of April, but May would look actually just a hair worse, unfortunately. We have not seen inflation at these levels since the 1970s. And one of the challenges about this is that we have, as you all know, a tremendous amount of debt outstanding in this country, and we are not unique. Around the world, most countries are seeing these same inflationary pressures, and most countries also have a tremendous amount of debt outstanding from a combination of the global financial crisis and COVID. So what that means is, if inflation were to stay elevated for quite some period of time, you would see interest rates go up as well, which means the cost of servicing that government debt becomes very problematic for countries around the world, not just here. So central bankers are very focused on getting this inflation under control because, quite frankly, we can't afford to pay 7 or 8% interest rates on our debt, nor can other countries around the world. So the Fed's focus right now is shifting towards being concerned about inflation. And what that means, it's a perspective that we haven't really had from our Fed for the last, call it 40 years, right? Since Volcker fought inflation in the early 1980s. And the markets have to some extent had the benefit of, if you've all heard the term, the Fed put, the Fed willing to step in if there's a problem in the economy, if markets are down significantly, and lower rates and create a little breathing room, and then markets stabilize and off we go again. The Fed's priority is not that now. The Fed's priority is making sure that inflation gets under control because we can't afford to service our debt, nor can other countries otherwise. So that's going to create, I think, ongoing volatility in this market that is probably different than what we've seen for the last 20 years or so. We had some very sharp sell-offs during the global financial crisis, sharp and steep, and during COVID, but actually the recoveries in the markets were relatively quick. Versus in the internet bubble, you all may recall, markets started to sell off in early 2000. They really didn't bottom until 2003. I remember this very clearly because I was working and investing every day, and it was pretty miserable for 3 years. So it's going to, I think, potentially feel different, and it may last quite a bit longer than what we're used to. Now, one thing on the inflationary side, in terms of a shift in the pressures that we've seen, I think this chart on the right is very interesting. So in this chart on the right, it looks at month over month inflation rather than the annual. And you can kind of see if it's accelerating or decelerating and what's driving it. In dark blue, we have goods, the goods contribution to inflation, so stuff, right? And then in the light blue, we have services, which effectively you can read as labor, right? So when we first saw inflation emerge post-COVID, you can see the dark blue bars were really the drivers. And that's when we saw, as you all know, elevated pricing in timber. I don't think feeds into this directly, but you saw timber, automobiles were a huge driver of that goods inflation, where we saw there wasn't enough used cars. Once everyone realized they did need a car again. And then the supply chains were disrupted on the semiconductor side. And so we all know the stories there. And that's where people thought this type of inflation would probably be transitory, because once we work through those supply chain issues, we would get back to normal. And actually, you can see the dark blue bar. I think that's the March print actually went negative for a brief period of time. So now in the most recent May print, goods again are contributing to inflation. But what has emerged, the general trend that's emerged more recently, is that services, i.e. labor, is now driving the inflationary pressures. And the labor markets, particularly in the US, are very, very tight right now. And that's where a lot of that pressure is coming from. So if you look at this chart here on the top, it shows the job openings over the unemployment percentage. So basically right now, you can see it's as high as it's been in the last 20 some years. And basically for every job opening, or for every 1.5 to almost 2 job openings there's only one person looking for a job, which, as you all know, if anyone's tried to hire in this current environment, is why it's so difficult to hire anyone, and why that's creating so much wage pressure, and also why then people are leaving for other jobs at higher wages. You know, so there's a nice correlation here. And then if you look at the bottom chart, what is the year-over-year wage growth? With that tight labor market, you're getting very strong year-over-year wage growth. This ties into a little bit earlier what I was saying about what is the Fed doing right now, and how are they going to focus on getting on top of inflation? Well, now that we're starting to see wage growth really drive that services inflation, it's hard to see how the Fed's really going to slow this down without, frankly, creating some sort of recession that involves loosening up the labor market. And wage inflation can become very persistent. As you all know, running finance offices for colleges and universities, once everyone starts to expect a 4% or a 5% raise every year, it's really hard to change your mind on that, right? So the Fed really wants to get on top of this so that anticipated wage growth doesn't become embedded in our economy. And most likely, while there's talk of some sort of soft landing, it's going to be really hard. It's just the honest answer. It's going to be really hard to get some looseness in the labor market that lowers these pressures on wages without creating an actual recession. So really quickly, before we look at some more data, I'm just curious for the group, what are your inflation expectations for 2023? I intentionally picked 2023, not this year, because we've got a lot of stuff going on this year. But in 2023, we might hopefully have settled a little bit past some of the supply chain disruptions, at least. I think the lingering impacts of, you know, what's happened with Russia and the Ukraine on oil and gas markets are probably likely to continue. But would love to hear, do I have to press again? Did you get the answers? Oh, there we go. Okay. So interesting. So the top one was, how do we know what is red and what is green and what is orange? Can I go back? Oh, there it is. Okay, there it is. Okay, sorry. I see now. I was like, sorry. So the vast majority of folks here, or not the vast majority, but the majority are thinking over 4%, with a little over a third at 3 to 4%. So let's just say, 80% of you are thinking inflation will be running over 3% in 2023. And that's pretty similar with what the markets are pricing in, particularly after that May inflation print. Interestingly, 5-year break-even assumptions on inflation right now are actually just a little over 3. They're about 3.1. So the broader market at this point in time is pricing in that we'll continue to have some elevated inflation right now. Over the next few years, we're going to head back down towards 3. But again, that's a more elevated level than what we've had the last 20 years or so. And this is just a chart on what the markets are pricing in, but it's a little dated now because it was as of the end of April, and assumptions have gone up a little bit since the recent inflation print. But you can see even as of the end of April, 5-year and 10-year inflation break-evens were hovering around 3. They've come up a little bit since then. There is some positive news out there. So, it's not all doom and gloom. At the moment, economies are still pretty strong. On the left-hand side here, we can see the Purchasing Managers Index, and you can see we've got different, Europe, US, Japan, China. China's the only one not in expansionary territory right now, and that's primarily because of their lockdowns associated with their zero COVID policy today. They had been in expansionary territory up until recently. And if you look on the right-hand side, this shows you what GDP estimates are for 2022. And you can see, well, they've come down since where they were at the start of the year. The diamonds represent the start of the year. The bars represent where we were at the end of April in terms of GDP assumptions. But you can see they've come down, but they're still pretty good. I mean, US GDP growth over 3% is really not bad. We've been more, we've been sub that for many years in the past. And if China can get something, closer to 5, China has been the largest driver of global GDP growth for many years now. That's not looking too bad. The question will be with central banks around the world raising rates and trying to create the looseness in the economy that I mentioned earlier, will we be able to stay anywhere near these levels? And from that standpoint, in terms of orchestrating a soft landing, this chart goes back to 1960. And it looks at Fed funds rates across that period. And it also looks at the gray bars are recessions. And the red arrows point to the 3 times in that entire almost 60-year time horizon that they've been able to orchestrate a soft landing. It's very, very hard to do. So you can see in other periods where the blue, which is where the Fed funds rate starts to go up, generally there's a gray bar right around that time or right after it, meaning as the Fed raised rates, it ultimately pushed the economy into a recession. The other thing, of course, that we all know about this chart, but seeing it this way, I think is quite interesting, is if you look at where rates are on the far right-hand side of the page there, we've got potentially a long way to go up. If we do not get the current inflationary trend under control. Bonds, let's talk a little bit about bonds. At the bottom of this chart here, we can see the correlation between stocks and bonds. And for most of the adult lives of the folks in this room, the correlation of stocks and bonds has been negative, meaning when stocks go down, typically bonds go up. It's really nice natural diversification in your portfolio. So that works really well, except when it doesn't. What people don't always tell you is correlations are not stable over time and across all environments. And during a period like the one we're in today, and during a period like the 1970s, which you can see highlighted in gray here, stocks and bonds can become very positively correlated. And we've seen that in the markets so far this year. So many of you that follow markets closely will probably know that the Barclays aggregate is down, not much different than what the US equity market is down so far for this calendar year. So that's the positive correlation in portfolios. And it really emphasizes the importance of having diversification in your portfolio that goes beyond stocks and bonds, right? Because if you're trying to find a place to spend from at the moment and your only choices are stocks and bonds, you're going to have to sell something that's down. And that's what we're trying to avoid over time. So I'm curious, some of the other things that you can add to your portfolio. We're going to talk about inflation sensitive assets. We're going to talk about diversifiers. But curious today, how many of you are either adding inflation sensitive assets in your portfolio, holding them constant, or reducing them probably to fund spending? And it looks like most, I'm going to let it ease out a little bit. Most folks are holding constant the level of real assets in their portfolio. Some are on the bias, maybe adding a little bit inflation sensitive assets, and some are reducing. And depending on where your portfolio is at this point in time and what your operating budget sensitivity is to inflation, what your spending is, all of these answers may make tremendous sense. And so I think it's interesting, though, to see on balance what folks are doing. So let's talk a little bit about adding inflation sensitive assets to the portfolio or not. We recently did a white paper on this topic. And because it's a question that we're getting at every investment committee meeting right now, depending on where the client's at, should we be adding more inflation sensitive assets to the portfolio or should we not? They have appreciated a fair bit already this year and in the back half of last year. And the underlying conclusion that we draw on this paper and that we would suggest is this needs to be either a permanent policy decision or it's probably not a good idea to do it. What doesn't work very well is to try and come in and out of real assets in your portfolio. You're thinking that you're going to be able to tactically time the market. But if you decide to make real assets a permanent part of your policy portfolio over the long term, they typically do serve you well. So we suggest to clients make that a pivotal part of your conversation. What is our operating budget sensitivity to inflation? How dependent are we on the endowment to fund that operating budget? And if so, that should drive probably whether or not you have an inflation sensitive asset over the long term. And one of the challenges here is if you go back to that first two cross arrow chart that I put up there, is when the environment shifts from accelerating inflation to decelerating inflation, you get a real rapid shift in the leadership of the market. So in light blue here, we have an accelerating inflation environment. And you can see here, and this looks like back over time, so you might not be able to see that number, but it says 1973 to 2021 is what this data comes from. So it does take most of the 1970s into account. And in an accelerating inflation environment in the light turquoise, you can see commodities do really well. Gold does really well. Surprisingly, even non-US developed, DM stands for developed market resource equities do well. And US REITs have done okay historically. And then you get towards the right-hand side, and not surprisingly, treasury bonds and things have not done particularly well when inflation is accelerating. But when we switch to a decelerating inflation environment, everything kind of flip-flops on its head in terms of where the market leadership is. So again, I think making the point that as you think about how do I diversify my portfolio, do I include real assets? Do I do it now if I haven't had them before? I think it's important to think about it for the long term when you make those decisions. And then also a little bit of breathing a small sigh of relief. It's not all bad news. When we're in periods of rising interest rates or high inflationary environments, there usually is a initial sell-off in the equity markets as valuations normalize to reflect a different discount rate. So we're all finance people here, I think, for the most part, in accounting. So you guys probably remember the discount rate from your dividend discount model. As interest rates go up, the discount rate goes up, and that means you need a lower valuation on your stocks in the market, which is the big adjustment we've seen so far. But once you get through that period, stocks actually aren't that bad of an inflation hedge. And if you look over these rising rate environments going back to 1972 in this chart, all the way up to most recently, and then you look at the median returns in the gray bar across the bottom, you can see US equities returning on average about 8% per year during these periods of rising interest rates. That's not so bad, right? Non-US equities actually doing a little bit better. That's measured by the MSCI All Country World ex-US Index, about 3 over, doing a little higher returns in emerging markets as well. And then the bond indices, not surprisingly, the Barclays Ag only a 2% return, 10-year Treasury is about flat, and you get a little bit better from commodities. But you know, the challenge might be you might not keep up with inflation, depending on how high inflation is, and in particular inflation plus your spend rate. But probably you're going to get some nominal returns out of your equity portfolio over time once we get through this initial investment period or readjustment period. So let's go to talking about portfolios. The primary objective for most of our clients, and I imagine for many of you in this room, is to earn a return from your endowment that is the combination of your spend rate plus inflation, right? So we've made a simple assumption here that spend might be 5%. We're typically seeing amongst college and universities that spend a little lower that. It's been more like 4.6, 4.7 on average. It varies a little bit by size. And our estimate for very long-term inflation is about 2.5. As we talked about a few minutes ago, current estimates for the next 5 to 10 years are more like 3, so a little bit higher. So let's say you're spending closer to 4.5, inflation's 3, you still might get to this 7.5% long-term nominal return target. So how many of you are concerned about the ability for your endowment to earn CPI plus spend over the next 10 years? Leveling out a little bit, a fair bit. And I think that's a fair concern for 2 reasons. 1, inflation is running a little higher. But 2, we've just come off of 12 of the best years for equity markets that we've ever seen. And valuations have normalized some now that we are technically in a bear market this year. We've seen a fair bit of normalization in valuations. The markets still aren't quite cheap yet. And so the combination of those 2 things, I think, does present a bit of a challenge for earning your CPI plus spend rate. And it's probably going to depend on your spend rate as well. Some of you that are in the room that might be closer to 4, that feels, I would say that probably feels a lot more comfortable. There may be some of you in this room that are at 6 or higher, and that's a more challenging number, as we all know, just from the math of what markets can deliver long term. So what is the philosophy that we work with clients to manage their endowments? And I'm sure many of you have a philosophy that's somewhat similar to this incorporated in your policy portfolios today. The first is that you have to have a large equity allocation in your portfolios to drive returns. Equities are the only asset class, if you look over long-term, 100-year type time horizons, that earns a 4 or 5% real return after inflation. Bonds just are not going to get you there. So you've really got to take a good bit of equity risk in your portfolio. But as we all know, equities can perform poorly in certain macroeconomic environments and can be quite volatile, in particular in environments where you have either deflation or inflation. So we typically like to have a portion of our portfolios that will be able to perform well in either of those 2 environments and be a source of spending and supporting operations in those 2 environments. And then lastly, we do think diversification should be the core principle in building portfolios. It is considered the only free lunch in investing, meaning if you put 2 assets together that are uncorrelated, you get a better compound return than you would have separately without those 2 things. And then lastly, sorry, I just realized it's cut off at the bottom here. We are a big believer in using alternative assets within portfolios as well. Private investments to really drive return. In our experience, a well-constructed private investment portfolio can outperform public markets by 3 to 5 percentage points per year. And we've seen even stronger outperformance than that most recently. And then hedge funds, we think, are important as well, particularly in a period of low interest rates, which we've been in and are still largely in. if we were in an environment where bond yields were at 5 to 7% and you were getting some real return on bonds, it was sort of a more normal environment, you might not need a hedge fund portfolio. But in today's environment, where, and particularly where we've been the last few years, where rates are quite low, hedge funds can be a great diversifier in your portfolio. And we've actually, I think, gotten even in this area. We're diversifying returns that are uncorrelated with equities, but can generate equity-like returns over time, with a view that the next few years in the markets might be a little bit more choppy. So, does diversification really work? Got this question a lot up until the last 4 months. People are believers in diversification again, but prior to that, because the S&P 500 in a simple bond portfolio was performing quite well, it was a question we were getting repeatedly. So we did this analysis, which looks at over rolling time periods, whether it's 1 year, 3 year, 5 years, 10 years, 15 years, how often does the diversified portfolio outperform the simple risk equivalent portfolio? And what we've used here for the diversified portfolio is we have taken the Cambridge Associates College and University entire universe and averaged out what the asset allocation is. It's buried in the footnotes if anyone likes to look at it, but we're going to see it in another page. And then we've compared that to the risk equivalent portfolio, which is about a 75% stock, 25% bond portfolio. And you can see, yes, over a 1 year time horizon, even a 3 year or 5 year time horizon, you have gotten some periods where the simple stock bond portfolio has outperformed the more diversified portfolio. But once you go back 10 or 15 years, 100% of the time, the diversified portfolio has outperformed the simple portfolio. And again, just making the argument, I think, for maintaining that diversification in your portfolios over the long term. And not only has it outperformed, but it's done so with less volatility, or less up and down movement, which, going back to the earlier conversation, again, if we're talking about your retirement plan and you're not spending from it, you don't care about volatility. But when we're talking about a college and university where you're spending every year, that's an important factor. Just a little data on the things I just said, just a chart going back to 1900, making the point that equities in blue are the only asset that's earned greater than a 4% real return. It's actually been a 6.6% real return net of inflation over this, on average per year of this 120-year time frame. It's important to keep in mind, though, when you look at this chart, the time horizons, right? So if you can eyeball the 1970s, which are just past the midpoint of the chart, and equities kind of go flat to sideways for quite a while, it's easy to look at this chart and say, oh, it's all fine. But when you're living through that period of time, it's going to feel and painful within a college or university. And we last saw this really coming out of the internet bubble, which is more sort of 3/4 of the way through. You can see the blue line kind of goes sideways for a while, ends with the global financial crisis, and then we've had this tremendous rally. But we could see some sideways markets for a while. And again, that's just where having the diversifiers and other things in your portfolio generate returns will be important. Sorry, I just realized that the way this formatted sent here, it's a little messed up, so I apologize for that. So you can see here, this looks at the mean allocation I was talking about for Cambridge Associates College and University clients. It's a pretty large group. It's not going to be that different than the Kubo. So it's going to represent, I think, a fairly good spectrum of where colleges and universities are. And you can see about 40% on average of portfolios in public equity, with 25% on top of that in private equity and venture capital. That has been the biggest return driver, and a lot of the size of that allocation right now for many institutions is going to be gains from what we saw in 2021 in the private markets. And then you have diversifiers just to the right of that. Average target allocation today around 16%. There are so many strategies you can fit into diversifiers. Many of them are various hedge fund strategies you may be familiar with, like long-short equity, convertible arbitrage, event arbitrage like mergers and acquisitions, but also things like high yield debt, emerging market debt, reinsurance. We actually have some rail car ownership and leasing strategies in our diversifiers today. So there's a lot of things that you can do in the diversifying part of the portfolio. And what we're typically trying to do there is produce returns that are in between fixed income and equities, but with volatility that's much closer to fixed income. So this, in an environment like the one we're in today, where stocks and bonds have become positively correlated and both are selling off, you can actually use your diversifiers and in addition to your inflation-sensitive assets to fund spending. And that's what we've been doing. So far this calendar year, inflation-sensitive assets have not surprisingly been our strongest performers, generating positive returns. But our diversifiers have held up incredibly well as well. In fact, in April, the vast majority of my clients' diversifiers portfolios produced a positive return, even though the equity markets were down about 8%. So we've been using that as a source of funds for spending as well. And then to the right, you've got the more macro-sensitive hedges in the portfolio. They're not large. They're there really to support spending in difficult periods for a year or two, basically. It's not going to help you forever, but it can help for a period in time. And in the inflation-sensitive area, this is only just a short list of what can be included in inflation-sensitive assets. We have seen a very significant shift to include more renewables and infrastructure and other strategies in the inflation-sensitive space, which have done pretty well. And obviously, right now, the more traditional commodities and natural resources part of the inflation-sensitive space has done quite well too. We're seeing many portfolios sort of use this as an opportunity to migrate more towards the energy transition side of things and capitalize on some of the gains elsewhere. And then the deflation-sensitive piece, high-quality stocks and bonds, high-quality bonds and cash. This can be a good source of spending in a deflationary environment, depending on how much duration you have in this part of your portfolio today. That can be a little bit more challenging right now. I wanted to pause there and see, does anyone have any questions or on thinking about broader policy? So returns from these types of portfolios. The right-hand side looks at long-term modeling of the portfolio that we just talked about there, that we're calling the long-term policy here. But it's really just a representative portfolio of the average compared to simple stock bond portfolios. And you can see a fair bit of outperformance anticipated over the long term without necessarily higher volatility. If you look at the chart on the left, this looks at if you had that diversified portfolio for the last 10 years, how would it have outperformed versus simple stock bond portfolios, and you can see pretty strongly. And also we've included on here CPI plus 5% during that 10-year time horizon. You can see the simple stock bond portfolios are just hovering at CPI plus 5%. They have gotten the job done over the last 10 years. We do think it might be more difficult for them to get the job done going forward, but you can, even over the last 10 years, you did better with the diversified portfolio. And I think that is all I have. So I'm not actually sure where we're at on time, but I'm happy to take any questions or discuss anything that might be top of mind for folks. Go ahead.
So the portfolio you have up there constructed, essentially bonds are no longer, you know, the whole 60-40 for you, maybe there's a 5%. Does that change if the interest rate on the 10-year goes to 6 or 7? Does that change in your mind if that happens? But if it's in the 3.5, bonds don't make sense in the portfolio based on some of the other diversifiers that you're talking about.
That's exactly right. So when I first started at the firm in 2004, when interest rates were quite a bit higher, we typically had 25% on average in policy portfolios in bonds. We had much smaller hedge fund allocations because you didn't really, you could use your bonds as more of a diversifier. And then you can see now we see bond allocations very low, typically representing just 1 to 2.5 years of spending for most institutions. I think if we do see interest rates go up to something more like a 5 or a 6, you will see those bond allocations come back up because they can be more of a return contributor to the overall performance goals than they have been able to be the last few years. But the one thing I'll say too, though, just to be clear, while we don't have a lot of actual bonds in the portfolios, the overall risk profile is still equivalent to about a 75% stock, 25% bond portfolio, because we're using the diversifiers to get that volatility down. The other thing we have seen, though, over the last 10 to 15 years is across the college and university universe, and it makes sense, as interest rates basically went to zero, or did go to zero at one point in time, you have seen the overall equity risk profile drift up from a 60-40 to a 70-30 to a 75-25. Other questions or comments?
Yes, it is. I apologize. But are there any asset classes that you're kind of avoiding now or would recommend that people avoid?
I don't think there's anything in particular I am avoiding at the moment. For two reasons. One, we typically try not to be all in or all out of any market because we don't really believe in market timing. So we will do some tactical shifting, and we do think policies can, while they're meant to be long-term, they do get influenced by the current interest rate environment. My answer might have been a little different 5 or 6 months ago, but now we've seen a fair correction in quite a few assets. So I would actually say for long-term folks, it's a pretty interesting time to invest if you think about your personal portfolios. And there's not really anything I would avoid. There's areas that I'm a little bit more confused about. In particular, it's not clear, for example, how the office space is going to sort out. We haven't seen as much dislocation in the office real estate market as you would think based on the fundamentals. We've got vacancy rates in New York City, I think like 19%. We've got every company, including mine, trying to figure out what their office footprint strategy is going to be going forward. But that market makes me a little nervous because I don't feel like that's been priced in as to how bad it could get. But I don't know. I'm sure there's still some opportunity some places in the office market.
I've got a question too. It doesn't necessarily relate to the market, but
they can't hear you online when you guys ask questions.
most institutions in here probably are using just a traditional 3-year rolling average for a spending policy or 12-quarter, 20-quarter rolling average. Do you have any thoughts on maybe changing the spending policy given what we're facing going forward? Are there any new, fresh ideas that you've seen or experienced that might be applicable to smaller institutions as well?
Yeah, it's a great question. One of the challenges with spending policies, I think there's trade-offs to whatever spending policy you choose, right? And I think over time in my years working with clients, I've seen a variety of policies and seen the pros and cons of all of them. I actually kind of think the 3-year average, it's simple and it has a few benefits to it, particularly possibly in the current environment. One, and this might be a somewhat controversial statement because I know it's difficult to manage any business, college, university, et cetera, during a difficult time. But one client once said to me, they'd rather have a 3-year spending rule than a 5, because with a 3-year spending rule, when there is an economic downturn and a downturn in the portfolio, and if you have to make some difficult decisions about your costs at the institution, everyone understands what's going on around them, right? So if it's tough to give people wage increases, if unfortunately there are some layoffs, people do understand they're in the middle of a recession, and it actually makes it easier to make those decisions. This person who had been a CFO for many years said he preferred that to the 5-year policy, because with the 5-year policy, by the time it's rolling through into impacting your spending, everyone's like, why are you doing this now? But everything's fine now. We're on our way out. And so it actually makes it more difficult, was his point of view. I thought that was a very interesting perspective. The other thing I will say is I have some clients that use what is more considered a hybrid policy with a cap and a floor, where you combine some sort of constant increase versus CPI with a 3-year rolling average. And that can create some smoothing, which is nice, I think, in terms of managing an operating budget. And so I think in most periods, that's actually probably going to be a very attractive policy for most CFOs and most finance offices. But in the environment that we're in today, and the potential difficulties we may see from a macro standpoint impacting portfolios, I think that could get you some weird results. So what might happen is you might see with one of those hybrid rules, your spending goes from being really low right now, because we're coming off of, at least up until the end of last year, some really strong markets. And so you've got all your constituents saying, what are you doing? Spend more money. To all of a sudden, it's flipped, and now you're spending over 6% because markets have sold off dramatically. So I think in periods of extreme volatility, hybrid policies can be a little difficult to manage as well. You know, one of the experiences that I have found over time is typically most clients will have their spending policy, and then the finance committee and the board, if they feel like additional spending is needed in a difficult environment, they'll make a decision on top of that. Questions? All right, well, I didn't see anyone sleeping, so you guys must not have had enough red pudding. But thank you very much for your time this afternoon. I hope the rest of the meeting